Welcome to Hash Commerce and Dollar Accounting. Today we will solve practical problems on depreciation accounting using two major methods, straight line method or SLM and written down value method or WDV. Depreciation is an essential concept in accounting, helping businesses track the reduction in asset value over time. Let's begin with practical examples. We will delve into detailed explanations and examples to master these methods. By the end, you'll have a solid understanding of how to apply SLM and WDV in real-world scenarios. Problem 1, depreciation calculation. Let's dive into the details of how to calculate depreciation using the straight line method, commonly referred to as SLM. Using the straight line method, or SLM, we start with the given data. The cost of the machine is 50,000 rupees. This is the initial amount spent to acquire the asset. The useful life of the machine is estimated to be 5 years. This means the machine is expected to be productive for this duration. The scrap value, or the residual value at the end of its useful life, is 5,000 rupees. This is the amount we expect to recover when the machine is sold or disposed of. The depreciation method we're using is the straight line method, or SLM. This method spreads the cost of the asset evenly over its useful life. Step 1. Apply the formula. The formula for annual depreciation is straightforward. Annual depreciation equals the cost of the asset minus the scrap value divided by the useful life. In this case, it is 50,000 minus 5,000 divided by 5. This equals 45,000 divided by 5, which results in 9,000. Therefore, the depreciation per year is 9,000 rupees. This is the amount by which the value of the machine will decrease each year. Step 2, depreciation. Account for 3 years. Let's calculate the depreciation for each of the first 3 years. In year 1, the depreciation is 9,000 rupees. In year 2, the depreciation remains 9,000 rupees. In year 3, the depreciation is again 9,000 rupees. The total depreciation for the 3 years is 27,000 rupees. This is the cumulative amount by which the machine's value has decreased over these years. This is how the straight line method simplifies the calculation of depreciation, making it easy to understand and apply. Stay tuned for more insights on different depreciation methods and their applications in various financial scenarios. Key takeaways from SLM: fixed depreciation amount every year. Useful for assets with consistent value usage like buildings and furniture. Now let's dive into the written down value method, or WDV. Given data cost of equipment equals 1 lakh rupees. Depreciation rate equals 10% per annum. Depreciation method equals written down value, or WDV. WDV calculates depreciation on the reduced balance of the asset each year. This method results in higher depreciation in the initial years and lower in later years. Ideal for assets that lose value quickly, like technology and machinery. Understanding both methods helps in making informed financial decisions. Step 1. Apply the formula. Depreciation equals rate times book value at the beginning of the year. This formula is fundamental in accounting and helps in understanding how the value of an asset decreases over time. For example, if the book value is $10,000 and the depreciation rate is 20%, the depreciation for the first year is $2,000. This means that the asset's value will be reduced by $2,000, reflecting its usage and wear and tear. Step 2. Calculate depreciation for 3 years. This step involves applying the same formula each year, but with the updated book value. In the second year, the book value is reduced by the first year's depreciation, making it $8,000. The depreciation for the second year is $1,600. This reduction continues to reflect the asset's decreasing value. In the third year, the book value is further reduced to $6,400 and the depreciation is $1,280. Each year, the book value decreases, and so does the depreciation amount. This method ensures that the asset's value decreases more in the earlier years, reflecting its usage and wear and tear. It is particularly useful for assets that lose value quickly in the initial years, such as vehicles or technology equipment. By using the written down value method, businesses can more accurately match the expense of using an asset with the revenue it generates, providing a clearer financial picture. Key takeaways from WDV: depreciation amount reduces every year. Best for assets that lose value quickly, like machinery and vehicles. Comparison of SLM versus WDV, criteria formula, depreciation amount, best for book value. The straight line method, SLM, spreads the cost evenly over the asset's useful life, making it predictable and simple. SLM is ideal for assets with consistent utility like buildings and office furniture. WDV, on the other hand, is more aggressive, reducing the book value faster in the initial years. This method is better suited for assets that depreciate quickly, providing a more realistic book value over time. Conclusion: SLM charges a fixed amount every year, making it ideal for buildings and furniture. WDV charges higher depreciation in the early years, which is best for machinery and vehicles. Choosing the right method depends on the asset type and business needs. Did you find this helpful? Don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more such accounting concepts. Drop your questions in the comments below. Stay tuned for more insightful videos to master your accounting skills. Let's test your understanding with a quick quiz. Question 1. What is the formula for calculating depreciation using the straight line method, SLM? Question 2. What type of assets is the written down value method, WDV, best suited for? Drop your answers in the comments below. In this chapter, we will explore real-world applications of depreciation accounting. Depreciation accounting is a fundamental concept in the world of finance and business, but its practical applications are what truly bring it to life. By understanding how depreciation is applied in real-world scenarios, we can gain a deeper appreciation for its importance in financial management and decision-making. How do businesses use these methods in their financial statements? Depreciation methods are not just numbers on a page, they are strategic tools that businesses use to manage their financial health. By carefully selecting and applying depreciation methods, companies can better align their financial statements with their operational realities, providing a more accurate picture of their financial performance. What are the implications for tax purposes? Let's dive in. Depreciation accounting has significant tax implications, as it directly affects a company's taxable income. By understanding the tax implications of different depreciation methods, businesses can make more informed decisions that optimize their tax liabilities and improve their overall financial health. Depreciation accounting isn't just a theoretical concept, it's a critical aspect of financial management that businesses use to reflect the wear and tear on their assets over time. This wear and tear, or depreciation, is an inevitable part of owning and using assets, and accounting for it accurately is essential for maintaining the integrity of financial statements. For instance, a company might use the straight line method, SLM, to depreciate office furniture and equipment. This method spreads the cost of the asset evenly over its useful life, providing a consistent expense amount each year. This consistency can be particularly useful for budgeting and financial planning, as it allows businesses to predict their expenses more accurately. This approach provides a consistent expense amount each year, making it easier for financial planning and budgeting. By using the straight line method, businesses can ensure that their financial statements reflect a steady and predictable expense pattern, which can be beneficial for long-term financial planning and stability. On the other hand, the written down value method, WDV, is often employed for assets like machinery or vehicles that lose value more rapidly in the initial years. This method allows businesses to account for the accelerated depreciation of these assets, providing a more accurate reflection of their declining value over time. This method allows businesses to match higher depreciation expenses with higher revenue periods, optimizing their tax liabilities. By aligning depreciation expenses with revenue, companies can better manage their cash flow and tax obligations, ensuring that they are not overburdened by tax liabilities during periods of lower revenue. Speaking of taxes, depreciation methods can have significant implications. The choice of depreciation method can affect a company's taxable income, cash flow, and overall financial health. By carefully selecting the appropriate depreciation method, businesses can optimize their tax liabilities and improve their financial performance. For example, accelerated depreciation methods like WDV can reduce taxable income in the early years of an asset's life, providing immediate tax relief. This can be particularly beneficial for businesses that need to manage their cash flow carefully, as it allows them to defer tax payments to later years when they may be in a better financial position. Now, imagine you're running a small business. As a small business owner, you have to make strategic decisions about how to manage your assets and finances. Choosing the right depreciation method is one of those critical decisions that can have a lasting impact on your business's financial health. How would you choose between SLM and WDV? The decision isn't just about accounting. It's a strategic move that can impact your cash flow, tax obligations, and overall financial health. By understanding the advantages and disadvantages of each method, you can make a more informed decision that aligns with your business goals and financial strategy. The decision isn't just about accounting, it's a strategic move that can impact your cash flow, tax obligations, and overall financial health. By carefully considering the implications of each method, you can choose the one that best supports your business's financial goals and long-term success. So whether you're an entrepreneur, a financial analyst, or just someone curious about accounting, understanding the real-world applications of depreciation can provide valuable insights into business operations and financial strategy. By gaining a deeper understanding of how depreciation works, you can make more informed decisions that support your financial goals and business success. Stay tuned for more in-depth discussions and examples in our upcoming videos. We will continue to explore the fascinating world of accounting and finance, providing you with the knowledge and tools you need to succeed in your business endeavors. Don't forget to like, share, and subscribe for more valuable content. Your support helps us continue to create informative and engaging content that empowers you to make better financial decisions.